Hello, and welcome to the first episode in our newest podcast miniseries, Engineering the SMB Capital Stack, sponsored by our friends at Fundbox. Now, I write a lot about small business lending, a lot. And the reason I'm so fixated on it is, to put it simply, it's really hard to do well. You take the things that are most difficult about commercial lending, stuff like the fact that companies, unlike consumers, are not homogenous and are thus very difficult to acquire, to evaluate, and to service. And then you mash that together with the things that make consumer lending really difficult, like the fact that in order to do it profitably, you have to operate efficiently at a massive scale. Well, that's what small business lending is. You take the hardest parts of commercial lending and consumer lending and you jam them together. It's essentially fintech on hard mode. And that's why it's interesting to me, because studying how small business lending is evolving and looking at which companies are succeeding in small business lending can tell us a lot, broadly, about how fintech as an industry is evolving and what it takes to win. In today's episode, I talk with Prashant Fuloria, CEO of Fundbox. We talk about the state of small businesses today, how they're doing, where they're struggling, and why access to capital remains the defining challenge for anyone starting or scaling a small business. Now, candidly, the reason I wanted to do this podcast series with Fundbox is that Prashant is one of the most thoughtful people I have ever met on the topic of small business lending. He has a ton of experience in this space, and perhaps more importantly, due to what Fundbox does, he has a very broad perspective on how the space is changing and how those changes are going to impact every stakeholder in the market. And that's really what this whole series is about. In future episodes, Prashant is going to join me as a co-host for these interviews, where we're going to talk to other experts in the small business lending community, diving deep into the different layers of the SMB capital stack, from underwriting to distribution to the changing role of banks. It's going to be a great series, and this episode today that you are about to listen to is a great discussion. I can't wait for you to hear it. So without further ado, here is episode 1 in our new series, Engineering the SMB Capital Stack, featuring Prashant Fuloria. Prashant, great to see you. Thanks for jumping on the podcast.
Good to see you again too, Alex.
This is going to be a lot of fun. As I mentioned in my intro, this is going to be the first in a series of conversations that we're going to be having on small businesses and small business lending and small business capital. And we have some great guests coming up in the series, which we're going to talk about a little later. But before we get there, I wanted to take this episode and use it as an opportunity to sort of level set where we are as it relates to the state of small businesses and their access to capital. So, Prashant, I'm going to ask for your patience as I monologue for a brief moment. Is that okay?
Absolutely, Alex. I love to hear you speak, so this is not going to be a problem for me at all.
Well, you're a good man for being patient. I really want to get your take on a lot of this data. So let me walk through a couple data points. This is all from the Federal Reserve's 2025 report on small business credit, which is based on a survey that they ran towards the end of 2024 of 7,600 small business owners. I love this survey, and I find it to be particularly instructive. It has really great longitudinal data, and it really, I think, particularly post the pandemic, really gives us a view of like what's been happening with small businesses from a credit and a capital perspective. So a couple pieces of information to wet everyone's whistle. The first is that according to this survey, small business owners have bounced back since the pandemic. However, the revenues that they reported in this survey have not quite yet recovered to pre-pandemic levels. So while they are up from the pandemic, which is good, they are not all the way back from where they were before the pandemic. And I think maybe more importantly, their sort of general level of optimism about the future is, to put it mildly, I would say mixed, right? And that's probably a result of sort of general economic uncertainty, as well as some of the specific challenges around funding and capital, which we're going to get into in a second. This also found that for the first time since 2021 in this survey, firms were more likely to report that revenues had decreased rather than increased in the year prior to the survey. So again, I mean, Prashant, this really reminds me of a lot of the consumer kind of macroeconomic stuff where you're like, it's okay, but we're also concerned, but we're not quite sure how concerned we are, right? So like it's kind of this quantum uncertainty that seems to be infecting really every part of the economy, and it's not something that small businesses are immune from. Second point, rising costs of goods, services, and or wages remain the most common financial challenge cited by respondents, with 75% of firms citing this issue. More than half of firms cited paying operating expenses, 56% of respondents, or uneven cash flows, 51% of respondents, as other significant financial challenges. Building on that, 37% of firms said that they had applied for a loan, line of credit, or merchant cash advance in the prior 12 months. So figure all of 2024 and the end of 2023, which was actually unchanged from the 2023 survey and in line with pre-pandemic levels. So overall rate of application for credit, relatively consistent. The survey also reported that small businesses are carrying more debt than they used to, which I thought was fascinating. The share of firms with more than $100,000 in outstanding debt remained higher than pre-pandemic levels, and elevated levels of existing debt, according to the small business owners, this was self-reported, played an increasing role in why they thought they were being denied for financing. I will also add at this point, I was at a different event a couple of weeks ago where a speaker, an economist who was talking about kind of the macroeconomic picture, one of the things that she said was that small business owners that are carrying a lot of debt are actually behaving a little differently than they used to. And it's not always showing up in the data, right? So this survey, I think, has pretty accurate data. But one of the things that she cautioned about was that in the past, a lot of times, small business owners would default on loans, go into bankruptcy. And that, like, there's a set of data that you can kind of track there in terms of like small business bankruptcies and that kind of stuff. She was saying that in a lot of cases, small business owners now are just packing up and just not returning calls and just kind of defaulting quietly. So there's not that formal bankruptcy process. So a lot of the potential financial stress doesn't show up necessarily in the bankruptcy numbers or other numbers that we're used to looking at, but it doesn't mean that small business owners aren't carrying a lot of debt or that they aren't somewhat stressed. Finally, a couple last things to wrap up on. Majority of small business owners continue to say, and this is very consistent, this is like, in some cases, part of the ethos of being a small business owner, I feel like, that they're not getting all the financing that they want. So 41% of applicants reported receiving all of the financing that they sought. And again, these are folks who did apply for financing. 36% received some, and 24% received none. So kind of breaking out different groups there. Applicants that firms were likely to apply to, this was interesting, they were actually much less likely to apply to large banks in 2024 for financing than in 2023. That dropped by about 5 percentage points between the 2 years. Applicants that sought financing at small banks were much more likely to be fully approved than those that sought financing from other lenders. And then finally, net satisfaction with lenders among financing applicants declined overall between 2023 and 2024. So small business owners were generally less satisfied. It fell by a startling 13% for online lenders, from a 15% to 2% saying that they were satisfied, which is one hell of a drop. And applicants at online lenders were more likely than applicants at other sources to experience challenges, including high interest rates and unfavorable repayment terms. Okay. Whew. All right. That was a lot of data. Prashant, thank you for hanging in there. I want to now get your take on all of that. So let's start with the issue of rising costs. That seems to be a persistent issue for small business owners and something that they're worried about. Is that something that you're seeing as a thing that's manifesting through the lenders and the platforms that you all work with?
So, Alex, I think that was a lot of useful contextual data for our conversation. Mm-hmm. And while we serve small businesses through platform partners like Intuit or Stripe or SoFi or vertical SaaS players like EverCommerce, we also talk directly with our small business customers all the time. Mm-hmm. And what you just said about rising costs being a concern to small business owners resonates and is emphasized by all the anecdotal conversations that we have, whether it's with a owner of a trucking company where he said that the repair costs for trucks is just going through the roof.
Sure.
And also the time that it takes to actually get the parts to be able to get your truck fixed is a lot longer. So there's almost a double whammy in terms of the impact on his business.
Mm-hmm.
Or someone who owns a burger grill, and she talked about the cost of buns and the cost of patties being very high, and her challenges around whether to pass those increased costs on to our customers or not. We do see this and we do hear this anecdotally all the time. I think when we talk to the platforms that we serve, I think we hear that from them as well. So, for example, we've had multiple platforms come to us and ask us, hey, can you provide purchase financing where our small business owners can take unexpected expenses and put them on an installment plan? And frankly, it's not just unexpected expenses. It's also things like payroll, which is very much an expected expense, right? So we do hear that from our platform partners. I mean, I've even heard of platform partners who are thinking about trying to help their small business customers reduce their costs through like group buying programs, right? Again, vertical specific, which I think is an interesting idea and so on. So I think we're definitely hearing this from customers directly and also from the various folks in the ecosystem that we work with.
Yeah, absolutely. No, it's interesting, right? Because I mean, I think it, again, as I was saying before, with the kind of macro picture, it dovetails a lot with what we see on the consumer side as well, which is just like people are looking for every avenue to split payments, to like just manage cash flow on such a granular level. And obviously, this is the world that small business owners have lived in forever. Like, that's not new if you've run a small business. But I think that just the degree to which these rising costs are really just further stressing businesses that didn't have a lot of margin to play with anyway is really notable, as well as the fact, and I'm glad you mentioned this, the time thing is huge, right? I mean, I've actually gone through this personally a few times recently where I'm trying to get my car fixed or whatever. And they're like, yeah, can you wait until like June of next year? I'm like, no, not really, you know? And it's like, that's personally inconveniencing to me. It's not existential to the survival of my business. And so like the delays and the challenges, especially if you're a small business owner, of not having any leverage or negotiating power or margin to play with at all, that's, I think, really good kind of broad context for, you know, thinking about small business owners' need for capital. So the other thing kind of following on that I also wanted to mention is small business owners reporting the kind of less satisfaction with the interest rates or repayment terms that they're getting from lenders. And that's obviously not like something that's true universally across the board, but it does seem to be kind of a rising trend. The reason I wanted to ask you about kind of the credit side of this on a macro level is Fundbox has been around for a while, right? So like you guys have seen different lending environments. You've been through different parts of the credit cycle. How would you classify where we are right now and kind of how small business lending is holding up, small business portfolios are holding up? Like, where are we in that cycle?
Yeah. So you're absolutely right, Alex. Fundbox started operating in 2015. And so we're coming up on 10 years of running a credit business and have seen a decent amount of economic fluctuations and have managed credit and capital through those cycles. In fact, we're just right now celebrating 10 years of our partnership with Intuit, which is kind of crazy and hard to believe, but we've been providing capital on the Intuit platform embedded inside of QuickBooks, initially desktop and then online, for 10 years. And there are some trends that we're seeing. So leading up to the pandemic, you had several years of what I might call a fairly benign environment and very steady, very stable. And in fact, I would say from an overall credit perspective, the last 12 to 18 months have been pretty stable too. But I think the underlying picture is a little bit different. So it might be worth digging into that a little bit. And we've got two vantage points from where we get our data. I mean, apart from conversations with platform partners, other folks in the space, banks, and so on. One is we've got our active customers whom we've approved for some financial product or the other who are using us and whom we are managing in some ways, assessing their credit worthiness continuously because we have a live data connection to one or more transactional data sources. And then the other vantage point is our connections with the underlying platforms, whether that's a bank account or whether that's an invoicing app or what have you, where we can see a broader set of data, not only for customers that we've approved and who are using Fundbox, but for other customers as well. I think in the first data set, we see strong credit performance, but that's a little confounded by the actions that we are taking. So it's a little bit hard to tease out and make an inference from the fact that we've seen robust credit performance, since 2022 with where we think the macro is. Because we're also doing things all the time, like improving our models and changing our underwriting, adding new partners, and so on. I think when we look at just broader platform data, we do see a few things that are at least indicative of all not being great in the economy, like, for example, increased cash flow volatility in general as a trend, or a higher rate of customer, call it churn, in the platforms. So those are things that suggest that all is not okay. There are some pockets of challenges. I will say that a lot of the uncertainty is also very, very specific to specific segments of the small business economy. And I think you really have to untangle that or disentangle that a little bit. So I'll give you a couple of examples. We've seen more stress in manufacturing, especially with tariffs, with some of the supply chain challenges that we even had back in 2023 and 24. However, professional services has done relatively well. So one of the elements of our business that we think is an asset and a strength is that we play across all of these different verticals. And so at any point in time, like in this case, professional services, relatively strong, manufacturing, a little more challenged. Because of our scale and diversity, we can kind of even out some of that when it comes to Fundbox itself. But we're seeing that. The other thing I will point out is B2C e-commerce was hurt quite significantly from a capital perspective over the last couple of years. And I think you've probably seen different data points of capital providers, lenders being challenged, the ones that focus exclusively on B2C e-commerce, because of one is the tariffs and some of the cross-border challenges, but the other is simply expectations that people had around the growth of e-commerce getting normalized as the pandemic effect wore off over time.
Right.
So there's definitely a vertical specific nuance to it. And I'm going to go one level deeper. Let's go to sub-verticals. If you look at construction as a broad set of NAICS codes, right? NAICS NAICS codes. Yes, it's a vertical, but in construction you have new construction, new building construction. You have maintenance, and maintenance is very different than new building construction. So if you try to get a plumber to fix a leaky faucet, they're booked all the time. This goes back to
they are. I know. It's driving me crazy right now.
Yeah, and so we of course have partners like House Call Pro and EverCommerce that focus on, call it, field services, and they're seeing a lot of activity. They're seeing their customers having very high demand.
Yeah,
which is a little bit different than what you might think of when you think of new building construction.
No, totally. That makes a lot of sense. I'm glad you added that nuance around the different verticals and sub-verticals, because as you and I have talked about many times in the past, small business is not, homogenous, right? Like it's not one big thing. It's a whole bunch of different areas that get stressed in different ways. And as much as I've been referencing kind of similar macro trends on the consumer side, that's one place where consumer and small business could not be more different, right? I mean, consumers are actually relatively homogenous. We don't like to say that we are, but we are. Whereas small business just really is very, very different depending on the sector. One of the other things that I sort of noted as I was reading through all of the different facts that I shared at the beginning is that a lot of the numbers I was looking at, they're sort of strangely holding steady, right? And are relatively consistent year to year. One of the ones that was consistent was the number about the small business owners reporting not getting as much financing as they wanted, and that sort of holding steady year to year and being pretty consistent, even prior to the pandemic as well. What do you make of that number? Because I think there's like multiple ways to interpret it. And again, it probably would benefit from some of your trademark nuance because, there probably are some small business owners that aren't getting approved for as much credit as they need or would be qualified for. There probably are some small business owners who aren't seeking credit but should be, which might be throwing off that number. Like if you didn't apply, you can't complain in this survey about the money that you didn't get when you didn't apply. But there probably are also businesses that are applying that maybe shouldn't be getting approved for any funding or as much as they might think that they need. So how do you parse that particular statistic?
I think there are a few trends that are happening in small business capital. I think the overall volume of small business capital that has been originated might be growing at a steady clip. Roughly, sure. I'm just going to give it's roughly, I think, about $500 billion a year of small business originations. Mm-hmm. One other trend there is that there is a shift from banks to fintechs.
Yeah.
Even though fintechs today are perhaps about, broadly speaking, 10%, and that number could be 12, it could even be 15, but it's not 25 and it's not 5%.
Right. Mm-hmm.
Fintechs are roughly 10% of the overall originations, and they're increasing. I think what's also happening a little bit is that banks have been pulling back, and so those dollars are going down.
Yeah.
Now, the other lens here is, it's one thing to look at the dollars. It's another thing to look at the number of customers who are being served.
Yeah.
Because your average bank loan, and I think typically a small business loan is considered to be anything that's sub 1 million, which is actually a large amount of money for many small business owners.
Yeah.
It's a lot of money.
Big. That's a lot of money.
Anyone. So if you look at sub $1 million loans, in terms of dollars, banks are still something like 2/3 or more of the originations, with the rest being filled by kind of traditional alternative lenders and fintechs. But if you look at the number of customers, I think you may actually see an inversion, because the average ticket size of a bank loan could be north of $200,000, but the average ticket size of a small business fintech origination could be, say, $20,000-$25,000. So there's a 10x difference, and so you have more than 1 million SMB owners getting financing from fintechs every year. Now, you may say, well, 1-2 million is still a drop in the bucket of 32-33 million, and that could very well be the case. But you're seeing that trend as well. So it's not entirely surprising, Alex, that the overarching number hasn't moved very much. I think it does reflect a little bit of a push and a pull, one being fintechs originating more, but the other one being banks pulling back. And so I think the result is a little bit of a status quo in some ways.
Yeah, it's kind of staying at the water level. That makes sense. And I think that, to add to your point, and this shows up actually in the data, I just gave some of the high level data, but everyone should read this report because it is really interesting. We've definitely seen share growing among fintech companies. I think the report sort of classifies them as either sort of non-bank finance companies or online lenders. It's always so funny to hear regulators define the different categories of fintech and use words that we haven't used for years in this industry, but like, we'll set that aside. But, if you look at the data, you definitely see that. And, as I said before, like, we saw a definite pullback reported on large banks in particular. And I was actually curious, just real quick, what do you think is behind a drop in small businesses even applying at large banks in 2024?
I think I saw another Fed report or some other data set or some other survey that suggested a concern about the process and the likelihood of getting declined as a reason why someone might not apply to their bank for a loan. And I want to go back to something you said earlier, Alex, which is, are there customers who are applying for credit who should not be applying because they're getting themselves into trouble? And that's something I think about a lot, because on the one hand, we want, as Fundbox, as a capital platform, we want to serve as many customers as possible with all of their credit needs. And we want to do that in as many platforms as possible and all of that good stuff. On the other hand, we want to build like long-term alignment between what's good for us, of course, but what's also good, importantly, for the small business customer and for the platform. So in some cases, providing too much credit can actually be dangerous and can lead to things like some businesses taking on too much debt. And I don't think that's a good thing for consumers or for SMBs, really.
Yeah, right.
And my litmus test of whether something is in a good place or not is the customer success aligned with the success of the capital provider and that of the platform? And at Fundbox, the majority of our originations and usage comes from repeat customers, like over 80% in any quarter, even though we are growing pretty fast. And our best customers are those who have used us for a long time. They use us once, use us again. Our average repeat customer uses us about 6 or 7 times a year. So they take capital in bite-sized chunks as and when they need it and pay us back whenever they can. And I think it's a win-win, because we grow with them. And so they're good customers for us from an economic perspective, but we're providing them something that they can grow with. And of course, it's a win for the platform as well, because they have healthier customers who transact more or move to the next level of their subscription tier and higher engagement and all of that good stuff. So I think in all of this conversation around access, I think in general, we want to give more, but we do have to be careful about folks taking on too much debt that they cannot service.
Well, that's interesting, actually, because it does also speak to the sort of psychology of small business owners. And this is something you and I have talked about before as well. Small business owners I've always joked that like starting a small business is not a rational thing to do, right? Like your positive expected value is not huge. People do it because they're passionate about it. People do it because they feel they have to, they feel motivated or driven in some way. But it's not like, if you look at the math, the best thing to do just economically. Most small businesses fail, as we know. Like it requires a special kind of person to be like, I'm going to do this thing, even though for the most part, it doesn't work nearly as well as we might imagine or hope that it will. And that's great, right? Like that is like the foundation of what makes our economy strong. And like people talk about the character of small business owners being sort of the character of America. Like I think all of that is 100% true. But it does require, and I think you touch on it really well, it does require a little bit sometimes, I think, of like protecting you from yourself, right? Because when you're passionate about something, you sort of sometimes can't see things clearly. And capital is the lifeblood of businesses, as we know. For small businesses, capital is always stressed. And there is oftentimes, I think, an urgency to acquire capital that might sort of overpower common sense a little bit. And I do think that is sneaking into that statistic a bit when we ask like, well, did you get all the money that you wanted? No. Well, the question they weren't asking as a follow-up is, do you really think the amount of money you were asking for is totally like rational and reasonable and what's best for your business? Like that's a harder question to ask, because, the joke I make sometimes is small business owners treat their businesses like parents treat like newborn babies. Like it's very emotionally important to them. And that speaks to one last part that I wanted to ask you about as it relates to the survey data, which is the drop in satisfaction for online lenders. And the relationship that online lenders have with small businesses truly fascinates me, because on the one hand, if you look at the data year to year, the usage of online lenders as a category actually went up between 2023 and 2024. They picked up a little bit of share relative to large banks, and I think community banks held relatively steady, but like they picked up a little bit of market share. At the same time, they saw this fairly dramatic drop in satisfaction with the small business owners saying, we're not happy about the pricing we're not happy about the terms, we don't always necessarily love the customer service. And it's interesting to have a category of providers that are both growing and picking up share, but at the same time losing share as it relates to like number of satisfied customers or people who report after having gotten the loan, not before, but after. Yeah, that was a good experience. I was happy with how that worked out. What do you make of this paradox around online lenders?
I think that was a fascinating stat. And frankly, after we talked about it earlier, I definitely want to go back and analyze this a lot better. Yeah. Because obviously, as someone that's running a capital platform, customer satisfaction is critical. Totally. There is this very positive sort of flywheel of us doing a good job, customers happy. We've got great Trustpilot scores, and our platform partners being happy and so on. I don't have any conclusive sort of hypothesis for what could be happening here. One thought I've had is that as embedded capital becomes more prevalent, I wonder whether people think of embedded capital as online lending. So
I was wondering that too.
So for example, if you're using QuickBooks Capital, is that an online lender? If you are using Stripe Capital, is that an online lender? If you're an EverCommerce customer and using EverCommerce Capital, it's EverCommerce with Fundbox powering. You're talking about these are all Fundbox partners.
Yeah.
What do you think of that? Is that an online lender, or are people thinking of the very classic? I'm going to go to a website that I have responded to or have clicked on in response to a Google advertisement or a direct mailer, and I'm explicitly applying for a loan or a line of credit or some of the financial product. I think that could be a driver of some of the trend that you just talked about.
Yeah, no, I mean, I'm glad you mentioned that. I feel exactly the same way, right? And I was even thinking about it in the context of, did you apply for credit last year? Well, what does apply for credit for a small business mean these days? It doesn't mean the same thing it used to mean, right? Like in the old days, it meant I walked into a branch, I took an afternoon off from running my business, which by the way, I didn't want to do because I'm busy making pizzas all day. But I took an afternoon off, I walked into the branch, I filled out a paper application, I gave it to them, and a couple of days later, I got an answer, yes or no. Then that evolved to, we digitized that application process, but the application process was still the same, right? I got an ad. I Googled, how do I get a small business loan in 15 minutes because I'm really stressed about the capital I have. I went to a website, I filled out an application, and I probably got an answer faster, which again, for small business owners, speed is one of those things that really does matter. But to your point about embedded finance, which is going to be a theme, just give people a hint in advance, like thematically, that's going to be important for the next couple of episodes that we're going to be doing, because it's really a growing trend in this space. In embedded, I mean, first of all, like, do you think of that as online? I guess it kind of is in the sense that it's like digitally embedded within a lot of like software workflows that you use, but I'm not like going to a web browser and applying for a loan. And the second part is I'm not necessarily even applying, right? Like in a lot of cases, the capital can be made sort of available on demand. You're sort of always kind of permanently approved for kind of a varying amount of capital. You click a button. Hey, I want to like, an example you and I have talked about before is like, just stretch out the cost of this next payroll because I don't have quite enough capital to cover that, but it's built into my payroll system. Like that, is that applying for loans? Is that an online lender? So I think there is definitely a shift in the way that people use these tools and access capital that might be coloring the data a little bit. I also think, and this is something I'd love to get your take on real fast. I've having spent a lot of time in lending, I've sort of come to see everything in the world in terms of positive and negative selection, Prashant. Like I'm walking around the world and I like see something happening in traffic out in the street and I'm like, negative selection. They were just negatively selected. Like I can't turn it off now that it's like in my head. But the reason I mention that is I do think that in the world of small business lending, you do see a lot of adverse selection, right? Where it's like, hey, I'm desperate for financing, so I'm going to go this route to go find that financing. And I am willing to accept things because of the position I'm in or feel that I'm in that I might not otherwise accept. And some of those things might also correlate with me being a riskier borrower. And then I accept terms or pricing that probably aren't great. And I know that, but I'm going to do it anyway. And then after, if you ask me, was I satisfied with that experience? I'm going to say no, or I didn't get approved for all of the funding that I want. So I do think the other thing that shows up in this online lending category are those models where they are sort of negatively selecting for customers who are just less likely to have a good experience just based on the characteristics of them getting financing or the characteristics of their business. What do you think about the sort of positive versus negative selection and how that's changing in small business lending?
I think customer selection is a very, very important driver of the success of embedded capital. I think it's one of the drivers. It's not the only driver.
Sure.
But the fact that rather than the customer having to come to you as a capital provider, you are going to the customer, you're showing up where they are already working and providing them an offer without them having to jump through hoops or even apply formally is a major driver of customer selection, of positive customer selection. And I think that's, if you add to that the brand loyalty that they may have with the platform that they're using. Hey, I've been using QuickBooks for the last 10 years, or I have been invoicing on this EverCommerce app called Invoice Simple, and that's how I run my business. I think that makes a big difference as well in terms of how folks think about the capital experience. So I think this is very, very important, and I'm glad you brought it up, because when people think about capital and small business capital, they often think about some of the first things are, what's the cost of acquisition? What is the data available? These are obviously very, very important, and we can talk more about them. But there's also an element of customer selection, and whether it's adverse or whether it's positive, that makes a big difference.
Yeah, I think that's right. I mean, just to add, one little point on top of that, it's kind of interesting because in some ways I sort of feel like, again, online lending. And I truly don't know how the Fed is defining that. I'm not sure the Fed knows how they're defining that exactly. I think to a degree, they just want good longitudinal data so they kind of keep the same categories, even as the market and the way that people use financing evolves. But like if we were to sort of classify online lending as that, go to their website, fill out an application, kind of standalone experience, in some ways, I kind of feel like that's sort of a historical aberration for how a lot of lending, especially on the small business side, has worked. Because if you think about it, to your point, bank lending, like I go into the branch lending, that was relationship lending, right? So there is a positive relationship. There is brand association that's positive. There is a larger set of services you're getting that you value. And that is going to tilt the playing field in favor of that provider because they can kind of count on that relationship sort of driving the type of behavior and the type of relationship they want to have with that borrower. By the same token, and I'm glad you illustrated this, you fast forward and kind of jump past this weird online lending phase we were in, where we're like, we can just carve off the lending from everything else and just do it standalone. If you sort of treated that as like a historical aberration that's kind of unusual, embedded lending is in a lot of ways getting back to the model that we used to have, which is this is a provider I have a larger relationship with. It is a place that I trust to conduct my business more broadly. And in that context, and in the context of that relationship, the performance, the level of uptake, the level of trust might be very, very different than that standalone category where we see these challenges around customer satisfaction.
Absolutely. It also plays into the business model because if you're trying to serve a small business customer, acquire them and then serve them, what you really want to do is to pull together a number of services under the same roof so that you can build a relationship. And in the case of a community bank, it was checking accounts, maybe your card, capital, and so on. In the case of a small business platform, it can be invoicing or payments or scheduling or other software along with capital or payroll and other such financial services. I think the thing in the middle where you're a standalone online lender, even the economics are hard to work out because you're spending something like $1,000 to $2,000 on online marketing or what have you, or direct mail to acquire the small business. And then once you've acquired them, the only thing you can give to them is a loan. And so that skews your incentives to be more aggressive during the sales process.
Yeah.
to really get them, whether it's a good idea for them or not, and really try to may potentially serve or give them as big a product as possible, because you really need to make your ROI, your marketing ROI, positive. And so I believe that platforms are sort of bifurcated into two parts. Either you're trying to be like an end-to-end, a one-stop shop for a small business, whether that's you're a horizontal player like an Intuit, or you're a vertical player like an EverCommerce. And then you have folks like Fundbox that are not trying to be a one-stop shop. I mean, it's a non-goal for us to be a one-stop shop for all of a small business's needs. We want to be the infrastructure player that helps all of these other folks become one-stop shops. So yes, we want our partners, folks like Zen Business or EverCommerce or Intuit or Stripe or what have you, to really build that deeper relationship. And we want to provide the right capabilities within their stack such that we honor their brand and their promise to their small business customers. We're aligned with their incentives and their customers' incentives. And I think that, to me, is sort of embedded capital in a nutshell. And I do agree that it's sort of in some ways going back to perhaps a healthier long-term relationship between kind of a platform or a bank and their customer.
No, I agree with that exactly. And I think that, it is kind of just one of those things where, you see these patterns kind of play themselves out. But the more that I think about how this space works and like what concepts are important, and you touched on it exactly, and it's going to be, I think, be a theme over the course of this series that we're going to do. The word alignment just matters so much, right? Like, how do we make sure that we're aligned to do this? Because the longer that I've worked in fintech, and I'm sure you probably feel the same way, the more I've really learned to distrust, like, well, we don't have alignment with like our business model or the way we go to market or whatever, but like, we want to treat customers the right way. And it's like, I don't even doubt your sincerity when you say that. It's just that, like, the reality is we are all subject to incentives and to business models, and to making sure that that alignment is something where it's not dependent on like goodwill or intentions. It's actually what's best for everyone. So we're going to talk a lot more about that. And I want to end today's discussion by sort of teeing up what we're going to talk about for the rest of this series. So we have 3 episodes upcoming. I would say in a lot of ways, roughly, they will reflect, Prashant, sort of the answers, or at least the way we would approach answering a question that I know you and I are both really obsessed with and have spent a lot of time thinking about, you more than me, but I'm an amateur in my curiosity on this subject. Why is small business lending so hard? And so I'd like for you, and you don't have to give your master's thesis on the answer to this question, but maybe the abridged version. Like, what are some areas when you think about the challenge of small business lending and serving small businesses, which we just spent a good chunk of time talking about, like the challenges they face? Why is it so hard? And then let's kind of segue from there into like what we're going to be exploring over the next couple episodes.
So small business capital is a huge market opportunity, but it's also very challenging. I think we would agree on that. Totally. I think there are three big drivers of that challenge. The first is it's a highly fragmented market, and customer acquisition is challenging. We talked about the $1,000 to $2,000 per SMB customer CAC, which makes it almost impossible to serve the smaller end of small businesses because the ROI doesn't quite work out. And I think embedded is a great way. Embedding the capital product inside of the tools that customers use every day is a great way to address some of those distribution challenges. Number one. Number two is, I think the small businesses are not homogeneous at all. It's not a one size fits all. And so even the data around small businesses is not quite as pristine as it might be on the consumer side. And so bureau data, et cetera, is just very sparse on small businesses. And this is where I think advancements in machine learning, using transactional data, Gen AI to use unstructured data, these kinds of tools help solve the problem of manually underwriting each and every small business, which costs thousands of dollars in human capital, and which it doesn't let you scale. I think the third one was the one that you brought up earlier, which is around small business is inherently sort of a bit of a risky space where there's high mortality and so on. So how do you create positive selection where you have the right folks applying for capital? And I think that goes back to the trust and the relationships they have with their platforms. So if you're embedding capital into a platform, you're benefiting from the trust, the positive selection, and especially if you're in the payment flow, you're also getting the de-risking of collecting as funds come in. So those are some of the reasons why I think small business capital has been challenging. And at the same time, there are these two trends. One is just the use of data, machine learning, AI, to help automate and scale a bunch of these underwriting and data challenges. And then the other is the product and delivering the product in a sort of credit and context, which is more embedded. And there are sort of several waves of embedded as well. Starting from embedded 1.0, I'm just going to plug my product and jam it into your interface, to embedded 2.0, where I'll actually use your data to do a better job underwriting, to what I call embedded 3.0, which is I'll provide the right product for what the poor customer is trying to do inside your platform in the first place. So there's a whole bunch of nuance to that. But I think that's a little bit of why this is a hard problem, why I do believe I'm very optimistic that this is sort of getting solved. We're starting to see some of the results of that. And if I fast forward over the next 10 years, I think we will be at a place where a large part of the problem will be quote unquote solved. That doesn't necessarily mean that every small business customer will be ecstatic. Some may still be declined for capital, but I think at least there will be good reasons for a small business owner not getting access to capital, maybe because their business is risky and they should think twice before getting capital, as opposed to either a bias in how they're being treated or some sort of friction in the process, or just some sort of economic reason why it's expensive to serve them, and things that really technology should sort of drive away.
Absolutely. No. So that was a great preview, actually, for the structure of the remainder of the series, which I'm going to walk through real fast. And I'd like you to chime in on why you're excited about these future episodes. So the plan is we're going to explore exactly what Prashant just laid out in terms of those challenges and how we can address them through embedded distribution models, through better data, through AI, through better underwriting. So the structure that we're going to pursue for the next 3 episodes is, Prashant, you're going to join me as a co-host for these episodes, which I'm very excited about because you've forgotten more about this subject than I will ever know. So I'm very grateful to have you with me to ask the smart questions. We are going to break this topic up into, I kind of think of it as like layers of the stack to a degree, right? So the first one we're going to do next episode is on data and underwriting. And as you illustrated, small businesses are just incredibly difficult to underwrite. And the classic sort of way of framing this has always been that, if it costs a bank the same amount to underwrite a large commercial loan as it does a small business loan, because the amount of manual work and evaluating bank statements and looking at cash flows and modeling those cash flows, like if it's all the same amount of work, roughly speaking, well, you're going to do commercial lending and you're not going to do small business lending, which is, I think, one way of describing what's happened with bank small business lending since 2010. We're going to explore what we can do to push on that problem and to make underwriting and the collection of data and the evaluation of data better. And Prashant, we have a great guest for that episode, right?
Yes. So we're thrilled to have with us Rich Franks. Rich Franks is currently the head of credit at Plaid. So obviously sitting at the intersection of credit and data at a very exciting and I'd say interesting time in Plaid's evolution as a platform. Sure. And I know you've written a lot about Plaid and open banking and all of that good stuff. So there's a ton of material there. Prior to that, Rich was the head of credit strategy at PayPal. So has seen some of the small business data and underwriting for PayPal working capital and PayPal business loans and all of that. And prior to that, he was actually the head of Lightbox at Credit Karma that acquired. Yeah. And so that's consumer, but not small business. But at the very least, it's an interesting model around how data can be used to increase access to capital for consumers. So thrilled to have him on board. And I think we'll really dig into some of those elements of data with him.
Totally agree. I will also say I know Rich personally a little bit, and we've done podcasts and other things before, and he's smart and hilarious and has great takes and stories on all of this. So I'm really looking forward to that discussion. Second, in this series of upcoming episodes, episode 3 is going to be about distribution. And distribution really is king, I think, in small business lending, as you illustrated. If you don't know how to acquire customers in a cost-effective way, if you don't have a larger environment with which to serve customers across multiple different dimensions, not just lending, the business model becomes really hard, and everything, as we talked about, sort of sits downstream of the business model. So really excited for that episode as well. Can you preview who our guest is for that one?
So when it comes to distribution and finding a scalable way to drive distribution of not just capital, but financial products, there are a few companies that have had as much success as Stripe. And so we're super excited to have Tanay Jail, who is the head of product for Stripe Capital, joining us to talk about distribution. And famously, Stripe pioneered how to grow distribution by catching startups when they were young, and this is more of the Stripe Direct model, but then also providing embedded financial services for several platforms, and that's the Stripe Connect business. And Stripe Capital plays in both the direct and the connected business. And Tanay leads product for Stripe Capital, again, a valuable partner. And I think he can share a lot about how Stripe thinks about distribution, how Stripe thinks about capital in the context of their entire ecosystem, and how Stripe thinks about the flywheel of virtue and benefit coming from capital, happy small business owners, happy platforms, and so on. And so I think would be a fabulous person to talk to about distribution and sort of how the folks at Stripe think about this. Because what we do know is that they're very ambitious around capital and are thinking about this sort of in a very big way. And we've been fortunate to be part of the journey with them, helping them as they grow the Stripe Capital franchise. So again, excited to have Tanay on our podcast.
Yeah, it's going to be amazing. I've been obsessed with obviously everything Stripe does, but I think your point about the multiple different layers of small businesses, platforms. Stripe is obviously a platform, but it enables other platforms. It's like turtles all the way down, except it's platforms with funding sort of built in at different parts. So I'm really excited to dig into that and really kind of satisfy my own curiosity personally. And then finally, and certainly last but not least, we want to talk about, I think, the overall just evolution of the stack as a whole, right? And one of the best ways, I think, to conceptualize how this small business capital stack has changed is by looking at the changing role of banks, right? Because as I illustrated earlier when we were talking, in the old days, banks used to sort of do 100% of this, right? And the role of banks in providing capital to small businesses, I would say it's as important or even more important than it ever was before, but it's also very different than it used to be before. And we have a great guest for that episode too, if you want to tease her just briefly.
Absolutely. And Alex, before I talk about our guest, I think what's interesting is we seem to have come full circle where banks were providing all the financial services, including capital for small business owners. Then there was a time when everybody hated banks, and
we're going to destroy banks and take this business away from them. Yeah.
And then I think at some point greater wisdom prevailed, and I think folks are now understanding the important role that banks play in the ecosystem, and I think we see this even at Fundbox where we've launched through a partner connectivity into some of the bank's core processors like FIS and Jack Henry and Q2, and with a partner like Autobooks, which provides small business capabilities within the bank stack, we're now connected into 2,300 banks. And I think we're excited about that because even today, banks are still the first call for many, many small business owners, and banks have a lot of the resources, such as capital, to be able to serve those small businesses, but there may be gaps in what they've got. And I think fintech can help fill those gaps in the banking stack to be able to enable banks to play that bigger role. And frankly, over the next 10 years, if there are two things that happen, there is digital platforms that are kind of not banks growing and all of that good stuff with capital. But I think the other part, which could be huge, is just banks embracing financial technology more to serve their customers better. I think that'll have an equal impact, maybe even bigger impact on the small business economy. So with all of that said, I think we're very excited to have with us Jackie Reeses, who is the CEO of Lead Bank. Now, Jackie has been running Lead for the last 4 years. and has transformed Lead into a bank that works with a large number of financial technology firms, including Fundbox, to help originate our products. Prior to Lead, Jackie ran Square Capital, Square Banking. She built the bank at Square. So again, a bank, but in a different context, inside of a publicly traded financial technology company. She's also been on the board of the Federal Reserve. So sees banks and the banking stack, if you will, from a variety of different perspectives. And so I think we can throw a lot of questions at her and get all our bank-related questions answered in what I think would be a fascinating conversation.
Yeah, could not be more excited about that. Jackie is someone who I've gotten to know a bit over the years, and legend is a strong word for most people. It's not for Jackie in this space, as you outlined. She knows every corner of this really extremely well. The stuff they're doing at Lead is fascinating, and I think does tell us a lot about where the industry and where the stack is going and how it's evolving. So could not be more excited for that conversation. Prashant, could not be more excited to be doing this with you and having you co-host these episodes. It's funny. We've had just so many conversations offline about this where, like, when I got done with it, I'm like, that's a podcast. We just did a podcast. We didn't record it, but that was a podcast. So I'm glad that we're doing this next set of conversations where we get to geek out on this as podcasts that others can listen to. Thank you so much, and looking forward to carrying this forward.
Thank you, Alex. Just very excited about our upcoming conversations. And once again, when it comes to small business capital, I think you said it earlier, small business owners are passionate to a degree, almost an irrational degree.
Yeah.
I think in some ways, in an amazing, interesting parallel, we are passionate about small business capital, perhaps to an irrational degree, but I think that's what counts, and that's what we bring to the table when we think about and kind of build and solve some of these problems. So again, really excited about this and this conversation that we just had, and the ones that are coming up.
Couldn't have said it better myself. We will be back at this soon. Thank you, sir.
Thank you.